As of this moment, BigBear.ai Holdings, ticker BBAI, is trading at $7.22 per share, reflecting a drop of 27 cents or about 3.60% on the day. Now, the immediate, surface-level reaction is to lump this into the broader profit-taking we're seeing across the more speculative corners of the AI sector. The expectation is simple. When names like NVIDIA stock cool off, the smaller, more volatile players like BBAI get hit even harder. But the reality of today's move is likely far more nuanced than that. What we're seeing isn't just a sentiment shift, it's the market actively recalibrating its expectations around the timeline for BigBear's transition from a primarily government-focused contractor to a diversified commercial enterprise. And that specific friction point is where the real story is unfolding. Most people you talk to about BigBear.ai, whether they are making trades on the SoFi trading platform or managing their portfolio through Fidelity investments, see it as a smaller, more accessible version of Palantir. The belief is that you're getting in on the ground floor of a company that provides critical AI-driven intelligence to the U.S. government, defense, and intelligence communities. The narrative is compelling. In a world of increasing geopolitical instability, demand for this technology should, in theory, be almost infinite. And for a while, the stock's performance reflected that straightforward belief. However, this perspective is dangerously incomplete. It overlooks the inherent lumpiness of government contracts, the intense competition in the space, and the monumental difficulty of translating a product built for the Pentagon into something that a commercial logistics or manufacturing company can seamlessly integrate. The deeper truth is that BigBear.ai's future value isn't just about winning more government deals, it's about proving it can escape the cage of government contracting altogether. Let's dissect the recent price action, because it tells us a lot. This 3.60% decline today isn't happening in a vacuum. The stock has been incredibly volatile over the past few months, experiencing massive swings that would test the nerve of any investor, even those accustomed to the wild rides of Tesla stock or the crypto markets on the Robinhood platform. Trading volume today is moderate, suggesting this isn't a panic-driven sell-off, but rather a more methodical de-risking by holders. Looking at the chart, the stock is testing a key technical level. A failure to hold here could see it drift lower, while a bounce could signal that buyers are still willing to step in on dips. Institutional ownership data, which you can analyze on more advanced systems like the Interactive Brokers platform, shows an interesting mix. While some growth-oriented funds have been adding positions, other, more value-focused institutions have been trimming their stakes, likely concerned about the company's current lack of profitability and cash burn. This is the classic battleground stock scenario. The people using Robinhood fractional shares to build a small position see pure upside, while the portfolio managers at Fidelity Wealth Management are weighing the balance of risk and potential reward much more cautiously. This isn't just a stock, it's a referendum on the entire high-growth, speculative AI investment thesis. For those who are newer to the name, let's establish what BigBear.ai actually does. At its core, the company provides decision intelligence solutions. Think of it as software that takes in massive, complex data sets from various sources, like satellite imagery, sensor data, and logistics reports, and uses artificial intelligence to find patterns, predict outcomes, and recommend actions. Their main platforms, with names like Observe, Orient, and Dominate, are tailored for the high-stakes environments of the Department of Defense and the U.S. intelligence community. Their recent acquisition of Pangiam, a specialist in vision AI for facial recognition and threat detection, was a significant move to bolster their capabilities, particularly in areas like airport security and border control. This is a critical business, but it's also a project-based business. They bid on contracts, and their revenue is recognized over the life of those contracts. This is a fundamentally different business model than a recurring revenue software company, and it's a distinction that many engaging in online investing for the first time fail to fully appreciate. An investment in BBAI is a bet on their ability to consistently win these large competitive bids, which is a very different proposition from an investment in, say, Apple stock with its predictable consumer hardware cycles. The central tension now lies in the company's future outlook, and this is where expectation and reality are on a collision course. The bull case, the one that excites investors on SoFi Invest and other investing sites, is built on a few key pillars. First, the continued and accelerating adoption of AI by the U.S. government. Every new global conflict or security threat is frankly a potential catalyst for BigBear. Second is the successful integration and cross-selling of Pangiam's technology. If they can take Pangiam's commercial security tech and sell it to their existing government clients, and vice versa, the synergies could be substantial. Third is the genuine, albeit challenging, expansion into the commercial sector. If they can land a few major enterprise clients in logistics, manufacturing, or energy, it would completely change the narrative and the valuation multiple the market is willing to assign to the stock. It would prove the technology is adaptable and that the company can escape the confines of government budgets. However, the bear case is just as compelling and must be respected by anyone considering an individual brokerage account to buy shares. The biggest risk is a slowdown or disruption in government spending. A protracted budget battle in Congress or a shift in defense priorities could delay or cancel major contracts, pulling the rug out from under their revenue projections. Competition is another enormous factor. They aren't just competing with other small contractors, they're up against giants like Palantir and the massive established defense primes like Lockheed Martin and Northrop Grumman, who all have their own powerful AI divisions. The commercial pivot is also fraught with peril. The sales cycles are long, the competition is fierce, and the needs of a Fortune 500 company are very different from the needs of an intelligence agency. There's also the risk of further share dilution. As a company that is not yet profitable, they may need to raise more capital by issuing new stock, which would reduce the ownership stake of current shareholders. This is a common path for growth companies, but it's a risk that needs to be factored into any online investment strategy. I'm curious to know what you all think. Comment below with what you believe is the biggest risk facing BigBear's commercial expansion. Is it competition, the product market fit, or something else? When you step back and look at the whole picture, from the tools on the Fidelity trading platform to the simplicity of the Robinhood app, the story of BigBear.ai becomes clear. It's a company at a crossroads. The expectation is that of a rocket ship, fueled by the boundless potential of artificial intelligence and national security demand. The reality is that of a specialized contractor attempting a difficult and expensive pivot into a new market, all while navigating the unpredictable currents of government funding. The daily 3% swings are just noise. The real signal is in their execution. The next earnings report will be critical. Investors won't just be looking at the top-line revenue or the bottom-line loss. They will be scrutinizing the breakdown between government and commercial revenue. They will be listening for any commentary on the sales pipeline for their new commercial offerings. Any sign of tangible progress in diversifying their revenue base will be rewarded handsomely. Conversely, any indication that the commercial strategy is stalling could lead to a significant re-rating of the stock to the downside. An intelligent portfolio, perhaps one managed through Schwab Intelligent Portfolios or constructed carefully using Fidelity mutual funds, would likely classify BBAI as a high-risk, high-reward satellite holding, not a core position. For those looking for investment help or considering self-investing, understanding this distinction is absolutely crucial. In summary, the 3.60% drop in BBAI today isn't the story. It's a symptom. The real narrative is the market's wavering confidence in the speed and success of the company's strategic pivot. The widespread expectation of a smooth ride on the AI wave is clashing with the harsh reality of a complex business model in transition. Your job as an investor isn't to react to the daily price fluctuations, but to focus on the underlying fundamentals. Watch the contract wins, scrutinize the commercial revenue growth, and understand the competitive landscape. That is how you separate the durable reality from the fleeting market expectation. Disclaimer: this video is for educational and informational purposes only. It is not financial or investment advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. The content shared here reflects personal opinions, not professional recommendations. Don't forget to like, comment, and subscribe for more finance updates.